Imagine swapping any token on any chain, zero gas headaches, one-click speed, while a sleepy little coin called Heima sits around 30 cents, coiling inside a textbook falling wedge. On screen, we zoom through Heima's slick omni-chain UI, then freeze on a roadmap that screams Q3 liquidity mining and AI earn launch. Now picture the wedge snapping, liquidity pouring in, and an arrow racing toward 70 cents. Too bold? Maybe. But stick around, because in the next few minutes we'll break down the tech, the tokenomics, the catalysts, and the exact profit map that could turn today's pocket change into tomorrow's victory lap. Strap in, hit like if you love asymmetric plays, and let's dive into one of the most overlooked cross-chain sleeper of 2025. The first image fades in. Heima's X-post with that purple banner, DeFi for everyone. Under the hood, it's intent-based routing plus account abstraction, jargon that basically means grandma can ape into Solana meme coins with USDC and never see a gas prompt. Heima's thesis is simple. Abstract the ugly bits. Let stablecoins open the door. The Genius Act reference in their tweet? That's regulatory tailwind, not fluff. If stablecoins become the first crypto most people hold, the rails that make them spendable across chains are gold. And Heima is the native grease inside those rails. Slide to the cross-chain transaction diagram. Before versus after chain abstraction. On the left, a spaghetti nightmare of MetaMask, Phantom, Trust Wallet, 3 networks, 3 gas tokens. On the right, a single MetaMask pipe leading into an Omni account, the complexity hidden like Tesla Autopilot. Here's where it gets interesting. Every swap still settles on-chain. Heima just bundles approvals, bridges liquidity, and routes it at the cheapest venue. That means protocol fees flow back to Heima's staking providers. Imagine Uniswap's fee engine, but chain agnostic. Now the mobile screenshots of PumpX. Users log in with an email, pay with any token, and Heima vaporizes gas. Volume on PumpX has climbed since integrating Heima's abstraction layer, according to internal dashboards shared in Discord. More volume equals more burn pressure, because 20% of network fees auto-buy and burn Heima token. That's a self-feeding loop we love to see, and one that most of crypto Twitter hasn't spotted yet. Cut to the token circulation donut chart. Out of the 100 million max supply, roughly 76.5 million are circulating, 1.6 million in staking, and 19.8 million locked for ecosystem incentives. Translation: only 4 out of every 5 tokens can actually hit the market right now, and the staking ratio is criminally low, just 1.65%. Even a tiny uptick in staking could squeeze supply. Oh, and note the split. 57% of float lives on Ethereum, 36% natively on Heima, 6% on BNB. That cross-chain distribution isn't accidental. It primes liquidity for arbitrage once volumes spike. The roadmap slide enters. A calming pastel timeline masking some seriously aggressive targets. Q2 finishes with Heima Layer 2 trading network, plus on board of a second decentralized exchange partner. Q3 flicks the green light on chain-level liquidity pools, meaning Heima staking providers start farming cross-chain fees by default. And Q4? Security hardening, and a shot at becoming the leading cross-chain service provider in Web3. Deadlines slip, sure, but Heima delivered PumpX integration on time, so credibility's higher than the average vaporware project. The screen now flashes the series of AI-earned tweets. Launch countdowns, sharp neon dashboards, and yes, trading agents named Neo and Lisa flexing sharp ratios above 2.5. Heima isn't pitching copy trading. They're offering self-custodial API bots driven by on-chain data and executed on Hyperliquid. That puts them smack in the cross-section of 2 explosive narratives: AI and intent-based finance. If even a fraction of Heima's 70,000 early access signups deploy capital on launch week, network activity, and by extension Heima fee burn, could spike faster than ChatGPT traffic last spring. Quick flashback to our old video on Litentry migration. The freshly pinned X reminder shows the swap portal still open with no hard deadline. That's bullish. Holders are not racing to dump. They're transitioning. More important, it keeps a trickle of demand as stragglers convert Litentry to Heima. If you missed that episode, catch it here or later on the end screen, because the background explains why the ticker changed but the mission stayed the same. Now, full screen trading view chart. For clarity, we're on the daily time frame and a falling wedge governs price since late April. Volume profile shows thick support right where price sits, around 30 cents, while liquidity thins dramatically above 35 cents. Two bright yellow trend lines converge, forming the falling wedge. The lower one has defended every sell-off since May 6th. Here's the plan. Green scenario, price pierces the upper wedge, retests 33 cents, confirms as support, and the first target sits at the 1 fib level, roughly 40 cents. We trail a stop to break even and trim 20% there. If momentum holds, TP2 aligns with the 1618 fib extension, 47 cents, another 30% trim. TP3 rides the 2618 at 60 cents, 30% trim. And TP4? The moonshot rests at the 3618 near 72 cents. Red scenario, bulls fumble. The wedge sends us back to the lower boundary around 28 cents. That's where patient traders can reload, because structural invalidation only happens if a weekly candle closes under that red dash stop-loss line. Anything above keeps the pattern in play. Heikinashi RSI backs the bull case. It just flipped positive, printing rising teal bars after a month consolidating. Historically, that uptick plus a wedge breakout has delivered double-digit rallies. Let's be blunt. Heima is thin liquidity, low cap, and news-driven. A single exploit or missed roadmap checkbox could nuke the setup. Position sizing is everything. I'm treating the stop-loss like a shotgun wedding. No second chances if we close the week below 28 cents. On the upside, the reward to risk runs north, even if we only tag TP2. That's asymmetric, and asymmetric is how small accounts grow fast. If Heima nails AI earn, scales chain abstraction, and locks total value locked behind its omni pools, Heima could graduate from speculative dart to infrastructure play. Think Stripe for stablecoins, only with tokenized skin in the game. Will it happen overnight? Of course not. But markets love a compelling story backed by visible milestones, and today's roadmap is tomorrow's chart pattern. So, here's your action list. Check the wedge, watch liquidity around 35 cents, track AI earn launch metrics, and if you learn something, smash that like button, nudge the subscribe, and drop a comment. Are you trading or holding Heima? What's your target? I'm in the comments every day, and I'd love your take. Oh, and the next video you must watch? That's our deep dive into the Litentry to Heima migration, even more context for this trade. Cue it up and keep the momentum flowing. By the way, if today's deep dive sparked your curiosity about how to earn real yield without turning yourself into a full-time trader, grab my ebook DeFi, Financial Freedom, the Ultimate Beginner's Guide. For just $4.99, you'll get a clear, battle-tested roadmap to picking reliable staking and farming pools, harvesting airdrops before the crowd, staying safe with smart contract checklists, and compounding rewards across multiple chains, no charts or scalp trades required. It's already helped a bunch of newbies turn idle crypto into steady passive income. The link is pinned in the top comment. Download it, put the strategies to work, and let your money hustle while you sleep. See you tomorrow in the next one.